Welcome everyone to today's SWA Take 5 Insights. I'm Tendai, joined by Jason, and today we're going to tackle a complex question. What can prevent the U.S. from going into economic recession? So Jason, first of all, the market seems to be doing great, right? They're resilient, they're hitting all-time records. Are we really still talking about the possibility of a recession?
So now that is a great question, and I think there is some concern with investors today. You look at some of the downward revisions in job numbers recently, some other economic indicators that are weak. But there are some good reasons why we could see a pickup in especially corporate capital expenditures going forward. And that's mainly due to increased confidence in the C-suite, CEOs, CFOs, et cetera, within corporate America. If you think back to the tariff announcements in April, of course, that caused confidence in C-suite and managers, people managing companies, to drop significantly because of all the uncertainty. I think since then we've had a lot more certainty about how the tariffs are going to turn out, which means that leaders of corporations are more willing to spend. But there are three reasons why corporate America is found fundamentally is very healthy and is willing to spend going forward. One is that overall balance sheets are very healthy, have a lot of cash on hand to put towards new capital expenditures. Number two, most companies with earnings can internally finance new projects, so they don't have to go out to the debt markets. They can just do it with cash flow. And the third thing I would say, Tendai, is that even for companies that have to borrow or go out to the debt markets to finance new projects, the weighted average cost of capital these days is still well below a return on investment. So even going out and issuing debt to finance new projects is very profitable for most of corporate America.
So it sounds like corporate America is financially strong and confident. Outside of that, what are other factors that could help us avoid going into an economic recession?
Yeah, there's a couple factors. First of all, bank lending is increasing. So there's a lot of deregulation in the banking sector these days. Capital requirements for banks has come down, so banks are more willing to lend, put that money to work. There's also some tax incentives for corporations. Part of the One Big Beautiful Bill Act that was recently passed allows companies that are investing or starting projects in plant equipment especially to depreciate those expenses right away. So that's incentive. And also fiscal expansion. Again, if you think of the OBBBA bill, a lot of that benefit is going to come in the next year or two in terms of incentives for companies to spend. So I think those are some big reasons. Another thing to keep in mind is CEO confidence was really low in April when the tariff wars really started. I think since then, there's still some uncertainty around tariffs, but we're much more confident in terms of how it's going to go potentially. And CEOs now are showing signs of more confidence putting money to work.
Okay. So we've talked about corporates, we've talked about various policies, but what about the consumer? You and I, how are we doing?
Consumers hanging in there. Latest readings that I saw were that even on an inflation-adjusted basis, consumers are spending more than they were a year ago. Job market, we talked about some downward revisions in new jobs, but the job market is still healthy. Unemployment rate is still solid. That should mean solid demand in consumer spending. So no big worries about the consumer, at least at this point.
So Jason, we've covered a lot, and a lot of things that we should be thinking about. Are there any looming concerns as we roll into the fourth quarter of this year?
Certainly, there's always concerns right now, whether it's geopolitics, local politics, inflation, what the Fed may do going forward. One thing to keep in mind is immigration policy in this country. We seem to be going from one extreme to the other in the past several years, and I think it would benefit the country to have a comprehensive compromise. We need more workers. Our demographics are counting on that in terms of looking forward, because more workers equals more demand and more economic output and growth. So that's something I think to keep in mind. All in all, less workers means less demand.
So a lot in this topic as we talked about, and as we start to land the plane, what are maybe a few takeaways that we can provide our folks today?
Sure. As far as the environment for capital expenditure, it's really solid right now. We talked about corporate strength in corporate America, balance sheets, able to have the resources and the cash flow to start new projects. Confidence has risen since April, and we have some policies that are really helpful in terms of encouraging companies to spend. And if companies are spending, that leads into economic growth. There's no telling. We could have a recession in the next quarter, next couple quarters, next year, 5 years from now. There will be another one eventually, but nothing that we're talking about in terms of a recession should ever take you off your long-term investment plan and go. We still feel like ignoring the short-term worries, sticking to the plan is the best way to get the best potential outcomes in terms of investing.
Jason, I love that. I love the reassurance of sticking to the long-term plan. You've done a great job here today, breaking down a very complex topic and making it digestible. And so should you have any follow-up questions, please reach out to Jason or myself or anybody else here at the Salient Wealth Advisors team. We'd be happy to help you. Until next time, take care.